Excellent. Good evening, everyone, and welcome to the Finance Committee of Tuesday, December 7th. Would the clerk please call the roll?
Yes, ma'am. Committee member Vilsa?
Here.
Committee member Burt?
Here.
Chair Cormack?
Here.
For the record, all present.
Excellent. We begin this evening, as always, with oral communications where members of the public may address us on topics within our purview that are not on this evening's agenda. This evening's agenda includes the long-range financial forecast, potential revenue-generating local ballot measures, specifically a utility tax, and the first quarter financial report. If any member of the public would like to address us, please go ahead and raise your hand in Zoom. I don't see any, and would the clerk please confirm that?
That is confirmed. No request to speak.
Thank you so much. Then we'll begin with our first action item, which is the long-range financial forecast.
Good evening, Finance Committee. Kylie Noze, Administrative Services Director. Here tonight, we have our budget team, which is led by our Budget Manager, Jessie Deschamps and Paul Harper, who will kick off the presentation. Ultimately, as this committee knows, very seasoned council members and committee members, this is the kickoff to our financial planning for FY 2023, our upcoming fiscal year. And this is in combination with the actions that the council has received in the current year activities, since we're in an anything but normal time and are doing our best to both keep a near-term look as well as a longer-term look. So with that, I'll turn it over to, I believe, Jessie Deschamps, who is going to kick us off.
Thank you, Kylie, and thank you for the intro. Just wait for these slides. There you go. All right, next slide, please. All right, starting with an overview, this forecast assumes a gradual improvement of the economic conditions and cautiously optimistic outlook for major tax revenues. Though many of the major tax revenues are experiencing growth in recent periods, several are still below pre-pandemic levels and will take a number of years to fully rebound. Expense projections in this forecast are based on reduced service levels. These service reductions were implemented in FY 21 and 22 to offset losses due to the pandemic and persist throughout all 10 years of the forecast. Though we are seeing positive signs of recovery at current resource levels, it will be necessary to prioritize service restorations and investments. Additionally, labor negotiations will be a key factor in budget development, as all bargaining units are out of contract as of FY 2023. Discussed in more detail in this presentation, there's currently a one-time surplus at the close of fiscal year 2021 and projected surplus in fiscal year 22 that could aid in near-term investments. And lastly, this forecast does not contemplate additional ongoing revenue sources, such as a potential ballot measure. However, this would allow for quicker service restorations and investments. Next slide. This slide presents the quarterly percentage change in GDP. The local economy had strong performance in the second and third calendar quarters of 2021, with the expectation this will continue in calendar year 22 and beyond, although at a slower growth rate. This is in part due to increasing vaccination rates and the resumption of economic activity, particularly in sectors that had previously been shut down, like restaurants, hotels, entertainment, and travel. At a national level, economy performance is strong, but is cooled as summer ended. GDP increased at an annual rate of 6.7% in the second quarter, followed by a 2.1% in the third quarter. That deceleration in GDP in the third quarter was led by a slowdown in consumer spending. In this quarter, a resurgence of the COVID-19 cases resulted in new restrictions and delays in the reopening of establishments. Additionally, government assistance payments for loans, grants, and other social benefits decreased. Next slide. All right, this base case reflects the current City Council approved service levels and a conservative recovery of major tax revenues. This forecast projects a one-time surplus of $2.4 million in fiscal year 2023, followed by a $1 million shortfall in fiscal year 2024, and small but increasing surpluses in fiscal years 25 through fiscal years 32. To the extent that a shortfall is not resolved or a surplus is not expended on an ongoing basis, these amounts will carry over to the following year. Therefore, if you're looking at that green net operating margin line, you'll see that if the 2.4 million is fully expended on an ongoing basis in fiscal year 2023, the shortfall in fiscal year 2024 will be 3.4 million. Fluctuations in the first few years of the forecast are primarily attributable to the elimination of ARPA funds in fiscal year 2024 and the restoration of base transfers to the Capital Improvement Fund, which will reach pre-pandemic levels by fiscal year 2026. We'll have a more detailed conversation of the revenue and expense projections by category in subsequent slides. And again, this base case does not assume restoration of service reductions. However, we will review an alternative scenario later in this presentation that does fully restore those services. Next slide. Okay, this busy graph presents the major tax revenues by category from 2014 to 2028. Tax projections utilize a number of sources, including national and local trends, historical experience, and various professional and consultancy sources. The red vertical line reflects 2019 actuals and acts as a benchmark for pre-pandemic levels. The gray highlighted figures indicate when actual or forecasted revenues reach pre-pandemic levels. So as you can see in this graph, there are a couple of categories that have already reached the pre-pandemic levels, and that's our property tax and documentary transfer tax, or DTT. Property tax is expected to plateau in 2021 and 2022 before resuming an upward trend. DTT experienced a record receipt of 10.6 million in fiscal year 2021 that was due to several large commercial transactions. This level of receipt is not anticipated in the future. As you can see, these revenues are volatile and subject to fluctuation. Sales tax and TOT were the most significantly impacted by the pandemic and do not reach pre-pandemic levels for several years. Sales tax in particular doesn't reach pre-pandemic levels until 2027, 2028. However, of note, the fiscal year 2019 sales tax receipts of 36.5 were higher by 0.7 million due to delays in fiscal year 18 transitioning to a new collection system. So therefore, that fiscal year 18 number is a little bit lower than it should have been, and the 19 number is a bit higher. Additionally, in recent periods, there's a little bit of fluctuation in sales tax due to options to businesses to defer payments over a 12-month period. So you'll see that in the forecast as well. And lastly, utility users tax, or UUT, has been impacted by water conservation programs, reduced workforces, and business closures that all resulted in lower utility consumption. These revenues are showing initial signs of recovery as workforces return to the office and are expected to reach pre-pandemic levels in fiscal year 2025. Next slide. This table presents the total general fund sources, including the tax revenues that we just reviewed in the prior slide, and non-tax revenues. The tax revenues consist of nearly 60% of overall general fund resources, and these are not expected to reach pre-pandemic levels until fiscal year 2024. Other fluctuations in the near-term revenues can be attributable to non-tax resources. Most significantly is the decrease in the ARPA funding. The city anticipates receiving 13.7 million in ARPA funds to smooth revenue losses resulting from the pandemic. 8.2 million, or 60% of that, is allocated in fiscal year 2022, and the remaining 5.5 million, or 40%, is allocated in fiscal year 2023. So you do see that drop off in 2024. This reduction in revenue is partially offset by the phase out of reserves for economically sensitive department revenues and the implementation of fee-based programs. The $5 million reserve for economically sensitive department revenues was established to mitigate unexpected department losses resulting from the pandemic. So these were things such as the extended delays to open JMZ and limited operations at city facilities. This forecast assumes the gradual improvement in the return of canceled or modified services by phasing out this reserve over 3 years, from 5 million in fiscal year 2022 to 2.5 million in fiscal year 2023 and 1.25 million in fiscal year 2024. And then lastly, new revenue sources are anticipated, such as the ambulance subscription and first responder fees in the fire department. These are present in 2022 and 2023 ongoing. Next slide. And with that, I will hand it over to Paul Harper to talk about expenditure projections and alternative scenarios.
Thank you, Jesse. Good evening, committee members. So this slide shows some of the major expenditure drivers that are changing over the 10-year forecast. First, we have the salary and benefits. They are budgeted based on current.
Paul,
Yes.
pardon me for interrupting. It's a
Sure.
little hard to hear you. Is there maybe another? Let's
Yeah,
try.
let
again.
It's
Let
a
me-
crackling.
Yeah.
Sure. Let me disconnect and reconnect my headphones 1 second.
Okay. I feel like I should be humming the Jeopardy music. Okay. Go ahead, Mr. Harper.
Sure. Is that better?
Still there.
Still there? All right. I'll just use my microphone on my computer.
Let's give that a
Can
try.
you guys hear me okay?
That's better.
Okay, all right. Sorry, so first we have the salary and benefits. Salary and benefits are budgeted based on current employee and their benefit selections as of fall 2021. Salary and benefits constitutes about 60% of the general fund budget, which is pretty typical. We've assumed a 2% salary increase, which is consistent with prior years because all of the bargaining units will be beyond their memorandum of agreement by the time we get to the end of fiscal year 2022. Retirement costs are also a major component of the salary and benefits. So this here is a graph showing the CalPERS projected retirement rates over the 10 years. You'll see that they peak in 2025 and then start to decline after that. This is due to the phase-in of the CalPERS discount rate of 7% by that year. And then as employees start to transition to lower cost pension plans such as PEPRA, we start to reduce the retirement rates after that. The next big driver, as Jesse mentioned, is the transfer to the Capital Improvement Fund. Previously, we had assumed that we were going to bring the base transfer from the general fund back to the pre-pandemic level by 2026. This continues that assumption. This also shows the breakdown between the base, the TOT amount, and then the Coverly amount that goes to the Coverly Infrastructure Fund. This will increase by about 6.2% from 2022 to 2023. And the TOT portion is in line with the TOT revenues that we are anticipating collecting over the next several years.
And Paul, just one point, if I can add for the committee's awareness, when you look at that TOT growth of the infrastructure TOT, recall that that has to also do with new hotels coming online that were not online prior to the pandemic. So if you're to compare the general TOT growth versus this infrastructure TOT growth, the growth rates are different. Obviously, it's a different population, but also there's a flat new add of quantity of rooms.
Yes.
Thanks,
Thank
Paul.
you. And then the next item is not quite a major driver, but we just wanted to highlight it to show that we're including it. These are the committed additions or the operating costs for new capital projects that are coming online. Projects such as the public safety building, the library materials handling project, Bulwer Park improvements. We're just trying to show that these have been included for things like janitorial services, facility maintenance, security, things like that, so that we are including those as the years go on and these projects come online. And then lastly, the global non-salary assumptions for anything that doesn't have an agreement in place. We've used the CPI from August to August, which at this point was 3.7% in 2023. And then in the years after, it's a 2.5% compounded increase on all the other budget groups, such as contract services, supplies and materials, general expenses, things like that. Next slide, please. This slide highlights some assumptions that are not included in the forecast. We've called these in the past the known unknowns. The first two, service restorations and labor negotiations, are actually modeled as part of the two alternate scenarios that we'll be talking about in a little bit. On the revenue side of the forecast, the potential November 2022 ballot initiative, which will be discussed also later tonight, could provide additional resources for the city. On the expense side, there are a number of master plans and citywide initiatives that will need funding in order to be worked on and implemented more fully, such as rail grade separation, the Parks Master Plan, and the Sustainability and Climate Action Plan. Next slide, please. So this slide shows our first scenario. It's modeled similarly to the base case to kind of see the comparison. Essentially, this scenario shows a full restoration of all of the reductions that were taken in fiscal year 21 and fiscal year 22 to address the financial impacts of the pandemic. As you can see, the gap increases greatly from what we had in the base case. In fiscal year 2023, it's about 11.0 million. And the revenues that are being generated currently couldn't sustain the expenses until about 3030 as part of this scenario. We're not saying that we should be restoring everything all at once, but this is just kind of the out there scenario to show you what would happen if we did try to do that at this point in time. Next slide, please. Scenario B, this is our compensation or market compensation adjustment. It models a 4% salary increase in fiscal year 2023 as opposed to the 2% that was in the base case. As you can see in 2023, this essentially eats up all of the surplus that we have, and the gap that was in 2024 increases and actually extends through 2025 before we get a surplus back in 2026. These two scenarios were modeled separately just to show the impacts of each one, but they could be added on top of each other to combine the effect of both of them if that's where council decides that they want to go. And I will now turn it over to Kylie to go ahead and finish up the budget development guidelines and the conclusion.
Great, thank you, team. On the next slide is just a summary of the annual budget development guidelines. And really, this talks about kind of just good financial practices and guidelines that the council reviews ultimately and adopts as part of or rather approves as part of this long-range financial forecast, and helps provide guidance to staff on the development of the upcoming budget. As we work internally to develop that and bring forward a proposed budget by the end of April, early May. So there are core concepts like one-time resources for one-time needs, identifying allocations for council priorities, and looking at new revenue sources. There are also some modifications in here talking about how do we not just, I think historically, obviously, we've been looking at reductions in services, but making sure that we are evaluating how we are restoring services and making sure that we're redesigning, exploring alternative service delivery models as we look at building back from the impacts that we've been adjusting for as a result of the pandemic. And of course, this council's hallmark and value-based of making sure that we are funding our long-term liabilities as we move through our financial planning. So those are the guidelines. They're in one of the attachments of the staff report. On the next slide, I believe we move to the conclusion. And so really, as you can see this year, as we move through this pandemic and these, I shouldn't say uncertain, as we move through these unknown kind of times, right? As we have new variants that come into play, or we have different economic environments that happen, or we're looking at kind of societal changes as a result of the pandemic. What staff has presented tonight are essentially 3 models that I think hopefully help provide guides for the council and the organization as we move into 2023. None of us can, perfectly project the future. And we by no means think that we've gotten every assumption in these long-range financials perfectly. But hopefully these models help provide benchmarks and a framework in which we will likely be operating as an organization as we move forward, providing some signs of positive revenue trends and focusing our attention as an organization on investing in the organization and services, but also recognizing the pace at which we can reinvest and build back, both from a financial perspective, from an uncertainty perspective, as well as just a capacity, hiring people, getting through contracts, doing our routine and good diligence from a governance perspective. We do have one-time funds for us to be looking at investing in transitions, in studies, in consulting services, in restorations. And we already have direction from the council, and we'll be returning at mid-year, frankly, to already start looking at restorations for additional restorations, or rather building back as part of the FY 2022 mid-year. So immediate next budget steps are going to be this. Ultimately, long range will ideally go to council in January of this next calendar year to help the new council have a nice ground setting as we move through the next 6 months, which is typically budget. February, we'll have a look at the 2022 mid-year budget. And so that will be another report similar to the preliminary Q1 report that the council received back in October, including budget adjustments this year. And then we do hit May of 2022, where we will be getting into the broader 2023 proposed budget process. Those are the budget deadlines. Obviously, there are other staff and council initiatives that are happening in parallel to this. So we do obviously have later on this evening, the ballot measures or potential ballot measures that will get layered on as part of the coming work plan for calendar year 2022. So with that, what staff is asking you on this next slide tonight is to review this long range. Next slide, please. Is to review this long range, accept it, and recommend the council use it as the starting point for the FY 2023 budget process. And with that, I will turn it back to the chair.
Thank you so much, Ms. Deschamps, Mr. Harper, and Director Nosey. Councilmember Fossett, do you have a question before we go to the public? Or are you just anxious?
Nope, I'm just getting my ducks in order here.
All
Go ahead,
righty.
go ahead and go to the public.
All right. All right.
I would
first-
like to go after the public.
I can see that. All right, so now we turn to members of the public who would like to provide public comment on this report this evening on the long range financial forecast. If you'd like to do so, please raise your hand in Zoom. All right, I don't see any, and if the clerk would confirm that.
That is confirmed, Chair Cormack.
All right, Councilmember Fossett, we will begin with you.
Thanks. I actually don't have too much. I think this is pretty comprehensive. One of my questions was table 9 in the staff report the right chart? And the answer, I think, was no, and that was the right one that you showed. So thank you very much. Couple observations. Why do we expect property tax growth is going to plateau for a couple of years?
So property tax growth is on a lag.
That's been consistently the thing that we've been appropriately conservative on and has bailed us out. Right? So
it has. And ultimately, the expectation is actually that what happens on property tax is you don't see the impact of the financial downturn or constraint in the year that it happens, like you see in, say, TOT or sales tax. Those are immediate impacts. Property tax is, a year in arrears, basically.
right.
So what typically happens here in Palo Alto is we don't see a decline in our property tax values. We actually see it plateau for a year and then continue from there. So this is a reflection of a few things. One, that the delay. So you actually see growth from FY 2020 to 2021, and that's part of that. Or 2022, I think. I might be getting my years wrong. And the other piece is ERAF. ERAF has been a one-time fluctuation as these funds come in and out. ERAF are what's called Excess Education Revenue Augmentation Fund. And those funds are typically one-time allocations, and they fluctuate based on kind of basically excess property taxes. It makes sure that the buckets for school districts and education are filled first, and then once those are, or if there are additional funds, there's a formula. What has happened unusually in the recent years is there have been challenges on those calculations and how the county has challenged them. So you are seeing a fluctuation of, and staff being conservative on will it grow, or also reserving, frankly, the funds that may be in question. So one dispute was actually recently resolved, as the council heard, as part of the preliminary Q1 financial status. And we reallocated that reserve to another litigation reserve. More recently, staff has learned that there's yet another new dispute that the county has alerted folks of. And so we are watching that and being cautious in how much growth we look at in the excess ERAF.
Okay, so.
Long-winded answer, but a lot of things.
No, but that's very helpful. So a substantial component of that is you're being conservative on ERAF. Okay. Because property tax increases other than ERAF come from a couple places, obviously. One is appreciation, and the other is, you know, the number of highly appreciated homes that turns over, right? To which has continued apace during the pandemic. Okay. All those nice charts of the surpluses starting in 2026, 25. They're all predicated, okay, on revenue growth of 3 to 4% and expense growth of 2%, which has never historically happened. So, okay, so the uptick in the surplus curve, yeah, I think we got to not, you know, plan too carefully that one's going to happen. And then I wanted to ask about, and it's not on a slide, but it's in the staff report, the contract services line that you and I we exchanged a couple emails on, goes from 17 million or something like that in 2021 to 30 million in 2022, and then stays at 30 million, you know, basically ongoing. So the 12 or 13 million dollar difference, what's in that?
I will actually ask Paul to help with some of that. But I do know that contract services is where we reserved litigation liabilities specific for the near term. And on the council side, the council chose to proactively reserve funds. And so as part of the FY 2022 budget, there was a 4-year plan and then a beyond 4-year plan. Right. So in the initial 4 years, there was $8 million that was supposed to be set aside annually, in association with the gas utility transfer challenge. Right. And then after that initial 4 years, it would drop down to $4 million annually.
Okay. Yep.
Now, there's one slight variation to that. The council proactively set aside the second year already as part of the Q1 financial. So we've actually set aside year 1 and 2 of those 4 years. And so what staff did was smooth the remainder over the remaining 3 years. So instead of 8 million over those years, I believe it's about 6.5 or so for those 3 years. So you won't see big fluctuations in the forecast. You'll see it pretty constant, and then you'll see about a $2 to $3 million change in that third year.
$2 to $3 million change.
And you should see it in, if I remember correctly.
Let me see, 18, 30, 30, 29, 30, 30, 28, 29, 29, 30, 30. Correct. 31. So it looks pretty flat. After the initial jump, looks pretty flat.
Sure. So the change is actually between FY25 and FY26. And obviously that is a small change. It's a $2.7 million change. Now, obviously
you're
that's going
right.
to be offset by the growth, the CPI growth. So you'll see a decrease of 2.7, but ultimately you'll also see an overlaid, just assumed growth. And so you're going to see the net of that. So you aren't going to see a massive change, but
Okay.
you should see a small dip between 25 and 26.
Let me think about that. So you're permanently reserving 4, but you're also assuming a CPI change. But won't those both push it in the same direction?
But remember, you are for the first 4 years, in addition to that 4, reserving a second 4 million.
A second, but that's not
that's
4 per year over the first 4 years, is it?
Yes,
Or is it? Or isn't?
it is.
Well, the total is 12 plus 4 a year, or it's 16 plus 4 a year.
So recall that the final amount in this current challenge is not determined. There is the period that was determined by the courts that has an identified figure, but obviously that that current challenge, I believe, handles through FY 2019. But
Yeah.
depending on the result of it, you still have the impacts of FY 2021, and then in FY 2022, we have been working through remedying it ongoing. So you still, it's not just what was identified in the case necessarily itself. Again, all depends on the outcome.
Okay. But the initial lump, not the ongoing 4 year, the initial lump you smoothed out over 4 years is what you've done. So you didn't sort of take it all from 21 to 22, and that's not where a 12 million step comes from. And then you continued to take it out, right? So it's
Right.
okay. Okay. But
But
the
between,
difference
remember,
between 18 and 2021 and 28 to 30 ongoing forever, is that primarily the green reserve?
there's an $8 million increase, yes, between FY 2021 and FY 2022 as a result of that litigation reserve.
Oh, it's 12 million, not 8. It's the increase.
So of that 12,
Of
8
the
million
12, 8
is
is-
associated with that.
Okay. All right. So it's in there. And that's where it is. Okay. Okay. All right.
Paul, do you have any additional color on what the additional increases between the 8 and the 12 million?
I was trying to find it. Unfortunately, I don't. I would probably venture to guess like JMZ opening up is probably part of it. I think we have some contractual services there, but I'd have to look into it a little bit more to kind of dig into that increase a little bit more.
Okay, thank you.
And then the revenue upsides, 5 million on for this year anyway. Of the is 5 million on property tax, 2.5 on sales tax, and 1 and change on TOT or something like that, for a total of 8 or 9 or something like that.
At current projections, yeah.
The current projections. Okay. All right. Super. Thanks.
Vice Mayor?
Sure, thanks. So first, can we have the slide that had the, I think the 10-year long-range forecast? And what I wanted to ask is, we have our, I think it's, we'll see here, a trailing 1 year, I think, on the forecast, but I wanted to see if we have, I think I went back and looked at a prior one. Let's see.
So perhaps slide 5 that has the actual 2019, actual 2020, actual 2021, current year projection, and then the coming 5 years.
Yeah, I was looking at table 4 in our packet. Is this the closest thing to that? Table 4 is it's got the total revenue and total expenditures, and the, but it I'm looking at the one time or the net operating impact and the one-time surpluses.
Sure. So this slide 5 is the source side. City Clerk, if you can go to slide 3, I believe that's the one the Vice Mayor is referring to.
Okay, thanks. And so we have in FY21 actual a 15.2 million surplus. And one of the things that I've seen over a long period of time on the forecast is that we typically project conservatively and then see that that things wind up stronger than our projections, and that's prudent. In this case, we're doing a projection without the restoration of services or the other compensation impact. So I think we're assuming that some combination of those two will be occurring. But when I look back at past projected deficits, just as a point of reference, I think that we had in the as recently as Q2 of this year, of February of this year, not Q2. We had a 6.8 million deficit projected for FY21. Is that correct?
So I'm not quite sure what you're referencing. If you
I
have a
think I
staff
went
report,
back
I'm
to
happy to.
the council packet from February on that. If I did this a week or two ago, so I think that's how I got it.
Sure.
And so I think that was our updated, when we had the update on the financial condition in February. I think that's what we had. And so I just wanted that as it doesn't predict anything in the future, but that's a big swing. That's so far, assuming that we don't come in at, well, we've got the actual already. So was that the forecast for, now I'm trying to figure out whether that was the forecast for, I think it was for FY22, maybe, not for 21.
Yeah, I think that might be what you're looking at.
Yeah,
The other thing that I would also caution is when we look at this actual of 2021 figure, the net one-time surplus and gap, that doesn't account for any adjustments that staff have made or council have made for things like timing difference. You know, the council does a reappropriation of funds every year in October. That's after adoption, after actuals, that trues up some of those perhaps surpluses. So for example, this year, I know we actually had some funding that was surplus in FY 2021 because it was specifically earmarked for COVID recovery. We actually weren't able to spend those funds. It's in the millions. It's over $1 million, I should say. We didn't spend those funds in FY 2021, therefore they show up as savings, which is why we see the expense number lower than the revenues. And we prudently did that because we weren't reopening. But the council did allocate those funds as part of the Q1 report and reappropriations. And so staff is actually spending those funds now. So appreciate what you're trying to do, Vice Mayor. I suspect we as staff could do a different portrayal to help show that full picture of kind of what the true impact is. And ultimately, from a BSR perspective, that's probably the closest number we have today, which is we're off by about 4.5 million. And that's that excess BSR from FY 2021.
Okay, yeah, so I think just for reference, I think in February projected a 2022 deficit of 6.8. We adopted a 2.7, and we're projecting a 10.7 surplus. Now, there are various factors that go into that, but those are big number swings, big differences. And I think it illustrates, the conservative projections. Now, we're going to continue to project conservatively. The question is how conservatively and what assumptions to make. And so I wanted to put this on the table as a point of reference to see how those recent projections have panned out in the whole. But then a few question.
One other place you got to throw into the mix from those projections is the forecasted transfer to infrastructure. Because at one point last year, we were projecting transferring $13 million to infrastructure for 21 and 18 and 22. And those numbers both decreased too, right? And those show up in the surplus and expenditures. On the other hand, the budget that they've got in front of us restores the infrastructure cuts over the next 5 years. So they were lighter in the first couple of years than expected and heavier than. And so you gotta factor those into the scenario too. That's all.
Yep. And that goes into, part of what we're going to be looking at is what assumptions we should make on transfers going forward. But on the sales tax, what do we have, or how do we factor in the trends in online sales, and how do they affect us as we see greater transition to online sales? As I recall, it's a percentage of our direct sales. Is that correct? As a proportion of the total, and do we have any anticipation of how trends may affect us there? Oh, you're muted. Sorry.
I'm on mute.
Yeah.
I was like, should I throw this to Jessie? I can see her boring into me. Let me, at a high level, kind of go over this and ask, we've got our experts, Taryn, as well as Jessie on the call to help round me out on this. You are correct. There is what's called the county pool, which is where the online sales go through. The county pool at a very high level is allocated based on the city's receipts compared to other jurisdictions in the county. So the city has actually been unfavorably impacted by the pandemic, as we've taken a more significant reduction in our receipts of sales tax. So at once we were at, about 7% of the county pool. We dropped down to about 5% of the county pool at some of the troughs of the pandemic, and we're growing back from there. I would have to ask staff for specifically where we're at, but I want to say we're probably at around the high 5%, maybe up to 6% of the county pool. So actually, as other folks saw increases in online sales, and therefore online sales helped their kind of impacts associated with the pandemic in terms of brick and mortar, or what's typically referred to as brick and mortar sales, we were kind of doubly hit. We lost both brick and mortar, and we also lost in terms of our share of the county pool. Other factors of that are not just pandemic related. They're also when certain jurisdictions may have spikes or agreements that allocate receipts to certain jurisdictions, and therefore their share of the proportional share of the county increases.
So are we assuming a return to our historic proportion of the county pool?
Not the 7%, but we are expecting to return obviously to a higher level. The reason why is there are jurisdictions in Santa Clara County that have reached sales tax agreements with certain private corporations, which has fundamentally shifted where our sales tax receipts are in alignment with other cities within the county jurisdiction. So we've accounted for those shifts.
And that's just happened the last couple of years?
Within the last 3 years, yeah.
And when did we see our proportion of the county pool drop? I thought it was just pandemic based. Was it before pandemic?
It all happened at the same rough time. So it was compounded, and we're not the only jurisdiction that feels that. So
yeah,
for
but
example,
we've had the pandemic impact for close to 2 years, but you were saying 3 years ago is when these jurisdictions struck these deals.
I said it's within the last 3 years. I would need to go figure out the actual implementation date and what specific quarter it went into effect.
Okay, that'd be going forward. I think that's informative because it tells us or indicates, it doesn't tell us to what degree we would expect to rebound to the county pool. Yeah.
Correct. Taryn,
Okay.
do you have additional information on when that any of those agreements went into effect?
Not the agreements, but overall to us, back in 2019, for example, we were about 7.4% of the county pools. In about 2020, the second quarter, we dropped to 5.1%. But at the same time, the county pool dollar amount increased. So on the one hand, our percentage went down. There was more online sales. Obviously, the pandemic was, we already had a trend of online sales growing. The pandemic kind of accelerated it. People bought a lot more stuff. Now, where that settles out as we kind of return to normal, we'll have to see whether some of that returns back to the brick and mortar or will continue. So the last quarter that we have, 2021 Q2, our percentage went down to about 5.6%. So it's kind of indicated in the 5 to 6% range. My expectation is that we'll probably stay within the 5 to 6% range. But again, the total pool is higher. So dollar-wise, we are still getting a nice chunk of it, even though our percentage as a total is going down. It's hard to predict what it will look like online sales, whether there'll any bounce back or this will be a permanent feature, people buying more online.
Okay, thanks. And then on the ERAF, in the staff report, it indicated that the county is recommending kind of an assumption of a 20% or a possibility of a 20% reduction if the school districts prevail. So first, I don't know what we think are the odds that they'll prevail. I don't know if the city attorney has any insight on that or anybody else. But second, I saw that we're using a 25% reserve or discounting that ERAF by 25%, whereas the county is saying 20% and it's 20% factored by the likelihood of it prevailing. So if it's a 20% loss that they're saying would occur if we lost the suit, we're assuming 100% chance that we'll lose the suit and a 25% greater loss from that suit than our advisors, the county, are saying.
Well, let me add a little color to that. So on the low side, the county is saying 20%. On the high side, they're saying 30%. 25 is kind of a mid-range, most likely one. So there's a possibility it could be higher than 20%. We didn't forecast the full 30% because it's kind of too high. The most likely probably is 25. So that's how we got bifurcating that.
The staff report at the bottom of page 11 says the county estimates that 20% of ERAF in FY22 is subject to this litigation.
They did say that, and that's what we stated. They most like, they stated it's probably around 20%, but the county is being conservative. So the most conservative worst case scenario to be like a super conservative, because there's a lot of unknowns, right? The litigation is in the very early stages. There'll be a lot of development. So the worst case scenario is 30, and to be honest, they're just picking out a conservative number of 30%. There's no mathematical basis for 30%. So basically, we went with the kind of somewhere in the between, and that reflects about 25%.
Okay.
In terms of the numbers that are forecasted. So which is approximately 1.5 million, which coincidentally was also the 1.5 previously that we had talked about.
And Molly, do you have any sense of the chances of the county or the schools prevailing?
Yeah, I can't give you a considered evaluation of that. That will be something I'll need to follow up.
Okay. And there was commentary on kind of projections on property tax. Do we have any preliminary projections from the assessor?
You mean beyond the 2022?
Yeah, let's see. That's where we're having our projection. It's a little odd. I don't know if you could pull this up, because looking at table 9, as Councilmember Phillips has said, is that table 9 we should ignore in the staff report? Is that right? So table 9 in the staff report, if I'm not misreading it, says that we're going from, it didn't make any sense with the narrative. So if you look at the staff report, property tax actuals and forecast, and it forecasts for 22 going from 43.1 million in 21 to 43.2 in 22, and then 44.3 in 23. But that's
Yeah,
not.
this table talks about in lieu vehicle license fees and airplanes and Hopter and stuff like that. Is that property tax?
Yes, those are all components of. So
Okay,
typically when we roll up property tax, we roll all of that together. This graph in table 9 specifically, Taryn called out all the individual components.
but they
didn't add it up.
But it doesn't add up to what we're projecting. It's got right there on the you see the dotted red line. It's 43 million and 43.2 for 22, and we're saying right below it in the narrative that we're at 56.5 in 22.
Sure, but recall the red line is only secured property tax. There's also unsecured, airplane, supplemental to get to the 56.
Okay.
Yeah,
0.5
they
million
didn't add it
there.
up to a total on it, if that's the right chart.
I see. All right, that's the clarification. Thanks. But there were in the narrative, there was a fair amount of discussion about kind of the assumptions and just on some of the trends, and you know, saying, for instance, in Q1 that we had, I think if I'm remembering right, residential properties were down a bit, but that's already rebounded. As Councilmember Philseth pointed out, that it's not primarily the annual appreciation of those residential property values that affects us. It's the number of homes that turn over from a very low tax basis to a very high tax basis. That's where we really get our money. And so, and that's that number of turnovers too is really what drives that DTT residential side as well. So I just I just want to well, I guess I did ask that one question, whether we have any projections from the assessor, or not projections, early estimates.
No, so the county only does the forecast. The first forecast it does is in August, and only for 2022. It never does any forecast beyond the current year. And even in the current year, so for example, in 2023, we won't have their forecast until August of that year. So when we're doing the budget year for 2023, city staff is actually doing the forecast. We have a HCL consultant that also helps us with data. Their forecast doesn't do excess ERAF supplemental or HOPTER. So we have to basically utilize historical information, current trends, the items you talked about, Councilmember Burt, the turnovers, the overall growth. For example, we have barely 1%. Typically, the 2% growth that the CPI in 2022, it was just slightly over 1%. What it will be in 23 will be challenging. As you may imagine, the bulk of our property doesn't turn over, and that's the CPI growth, while the documentary transfer tax and the additional growth does come from the turnovers.
Yeah, and we'll, you know, I think all the projections are indicating that residential property is staying throughout the region extremely strong, and you know, the IPOs are going to continue to drive that. The wild card is what's going to happen on the commercial property, and whether there could even be downward assessments, reassessments, and that's a big wild card that could be a problem.
Yes, it could go either way, up or down, and like you said, it's a wild card.
Well, I'd be very surprised if we'd on the commercial that we'd see a significant upward with kind of the transformations and office occupancies, where we are continuing to see interesting sales, but I think our greater risk at this point in time is a downward assessment.
Yeah, even the county staff is challenged by it. They have been trying to handle as the Prop 8 reductions that they do for residential side. they are also flummoxed. It's a new territory, and they are the experts, and even they don't know exactly how it's going to pan out.
Great. Okay, so that's all my questions for now. Thanks.
Thanks so much. Mr. Narayan, it's unusual to hear at a finance committee meeting that there's no mathematical basis for a number. That might be the first time I've heard that.
Well, 30%, but the 20 and the 25, there is.
Totally fair.
Welcome to government.
Well, I appreciate the honesty. I want to thank staff for slide 4. It is quite difficult going through these tables to extract things. And so the little gray boxes showing, okay, here's where we get back to pre-pandemic levels, et cetera. And I always appreciate the prior, in this sense, it's 10 years, really shows us the trends, right? And it is property tax right there that makes such a big difference. Slide 7 is the one that every year gives me a heart attack, which is all the things we don't know how we're going to pay for. So my annual reminder that at some point we have to figure those out. And I appreciate staff's description of the fact that, at this point we should be thinking about investments, which is really quite different than just assuming that things will be restorations. And there's all kinds of things we can invest in. At the end of my comments, I'm going to come back and I want to talk about inflation. We have not discussed that, and this is a really big topic. But I do want to just pick up on the property tax a little bit. So we did actually have a decline in the median sale family residential. And I wonder to what extent at all, I don't even know if it's possible, do we make any demographic assumptions about homes turning over on the residential side based on the age of our community and the fact that it's getting older? I mean, we've got a pretty steady trend, but I'm just wondering, do we ever factor in the demographics of Palo Alto itself?
We haven't looked at it this year, but in the past we have looked at what percentage of the properties were below like 600,000 in value that hadn't changed hands in a while. Of course, in terms of forecasting revenues, you would have to know how much will actually turn over, and not that clairvoyant. I haven't run into anybody that's clairvoyant. What we try to do is we try to look at historical turnovers, how many properties have turned over, what was the value of the property before they sold, what was the after one, what was the aggregate amount, and based on that, try to extrapolate what the average turnover might be on a going forward basis. Of course, like I said, only a small number of properties in terms of the total change hands. So it gets challenging to equate that back into the forecast.
Of course. Yeah, no, I appreciate that description. I guess one thing for us to just look for possibly is that the rate of change in the change, or the change in the rate of change, I think is what I mean. To the extent that if our population is aging, and I can imagine a scenario into which we hit a tipping point, essentially, where more people are needing to or choosing to sell their homes based on a change in their needs. So it's just something to think about. I think it'll probably be swamped by the rest of the things going on in there, but yes, go
Chair
ahead.
Cormack, actually, just one note, since this is a major driver associated with Palo Alto's property tax growth and unique to Palo Alto as opposed to, say, new development or something like that. Obviously, we know we have a very robust kind of value in the land and the property here. We do not necessarily look at age or that kind of demographic of the kind of society, but we do look at exactly what you said, the history of the transfer of ownership. And so we do look at, recent years, what has it been, what's that percent change, like you noted, in terms of the value growth when it transfers. And we can see historically, and we do look at about 5 years, we can see historically that that percentage change has decreased. So say 5 years ago, when you look at our total transfer of ownership, that's in about 2017, you're looking at about over 100% change in the value. But now you're looking at more in the 80s, 5
I see.
years. So we don't necessarily look
At a
at,
higher base though.
yes, exactly. The original value, you know, in 2017 was less than $1 billion. The original value in 2021 is over $1 billion. And so, you know, the sales value is still about, the current sales value is still about 2 billion. But to your point, the number of properties that are so far, as Taryn discussed, below what the current value is, will slowly edge up. And so that's something for us to continue to watch. We're not necessarily at a point where we've kind of maxed out and, you know, you're just turning over one for one. But we are seeing a very clear trend that is moving in that direction.
You know,
So-
we ask all sorts of detailed questions, and of course, everybody here wants more data, and some of our colleagues want even more data. But if I were to give you suggestions about what to focus on, right, this is the biggest one. So I think time spent, you know, understanding that, you know, my humble personal opinion, this is a good place to spend it.
Yes.
Okay, transient occupancy tax, table 10, page 13 of the staff report. Again, super helpful to have this and see, you know, all of this, yay, it's rebounding, is scary when you look at RevPAR was 280, you know, and now we're at 116 in, you know, the last full year. So, you know, I really, really appreciate having the longer time horizon here. Okay, don't really need an answer. I'm just going to say on page 17, the second half of the charges to other funds paragraph, I have no idea what you're talking about. It's a small number and hopefully you understand it, but like that's not written in a way that I understand. So just a little feedback there. And then finally, you know, I'm really struck by the fact that we are potentially for the first time in decades in a situation where inflation may not be transitory and may be meaningful. And how did that affect this long range forecast? And if not, how should we think about inflation over the period of this next 10 years? Obviously on the revenue and the expense side. So open-ended question.
Well, and I will open it up to the team for their thoughts on this. I think it is fair to say that that is a known and continuing to emerge issue on the rate and longevity of what that will be. In our revenue or our expense and revenue estimates, we did obviously increase our CPI in the near term since we've recognized that as we look at the data points. Over the 10-year forecast, we have not necessarily adjusted the underlying assumption since over that 10-year forecast, there is some level of smoothing. You'll see peaks and valleys, and what we always kind of talk about, and to Councilmember Phil's point, we always seem to be able to spend all of the surpluses, so they never totally materialize in that hockey stick type growth. We do try and match them in the more near term. I think it's a fair critique and thought to look at the longer term and is that 10-year average too low in the advent of where we're at? So if we were to go back historically and look at periods where we're seeing similar trends in terms of inflation, if we were to take a 10-year snapshot, what would that do to that kind of ongoing growth rate? But I do think we have done some level of adjusting in the current near term so that as we are making financial plans, we're doing our best to account for that in a reasonable but not overly conservative way, knowing that if we're too conservative, that could artificially create actually deficits that may or may not materialize. So always, as this committee has actually been terribly gracious and just informed that all of this is about risks. And in certain areas, we might have taken increased risk. In other areas, we might have backed off of it. And so it's a balancing act of making sure that we're not overstating anything, but we're, you know, and at the end of the day, it's somewhere that we feel is proactive and a solid footing for this organization to continue to use to plan our investments and our services.
Okay, thanks for that. I guess it might be worth including that in the staff report for when this goes to council.
Sure.
Just so, you know, our colleagues and the public understand the approach. Now, tonight you're looking for us to recommend the base case, or are you looking for us to weigh in on alternates A and B?
Ultimately, that's the committee's at the committee's discretion in terms of which one the committee would recommend the council consider as kind of the starting point for staff's development of the budget. Definitely in this time, I think it would be fair to articulate some nuances if that was the will of this committee. The base case, I think, is a good starting point, and I think the alternatives help model what things may or may not look like as we move through unknown variables such as discussions with our labor groups, as we move through what we can or can't, frankly, administratively add back, and at what pace can we look at reinvesting in services. Everything from recruiting to going to the market for partnerships for things, or finding new service providers and the like as we reinvest in the community.
Okay, and then you're also interested in feedback on the surplus in 2022?
Yeah, I guess if there is feedback, we do have clear direction from the council actually on that, in the
Right.
sense of Q1, the council made very clear to staff in their motion as part of mid-year, please come back with your priority restorations. Obviously, this committee, if there are recommendations, this long range will likely go to council prior to mid-year.
Okay.
And so that could be something that is, as a collective committee, you identify as priorities for the council's consideration.
Okay, but it sounds like we've got a plan for that. All right. The other thing, oh, sorry, now I just want to make sure I'm still in the right one. Just with the budget development guidelines. Did anything change in these?
Mhm.
So did we always have maintained fiscal sustainability over short, medium, and long term? We did? Okay,
Yes.
thanks, Mr. Harper. Anything in particular you want to highlight in the budget development guidelines that we should be aware of before we approve them?
Paul, I believe what we did was modernize them. Do you have additional color you want to share with the committee?
I think the nuances that we changed it from was, previously we were really looking at restorations or service changes that would cause long-term savings. So if you needed to invest in something that cost money up front, but it would generate longer-term savings, we were looking for that. We're still looking for that, but I think that was sort of the theme from last year. And also, because we were still looking at a very uncertain revenue projection going forward, we were really looking to keep the budget as status quo as possible, even reducing, because we still need to stay within our revenue projections. Going forward, we're looking more at, sustaining what we have, as you said, short, middle, long term, but we can start contemplating some restorations or bringing back services in different ways to provide them again.
Okay, great. Let's do another quick round then, and I'd appreciate if my colleagues could focus on the recommendation. So specifically, shall we just pass forward the base case, or do we want to make any changes? Yes, Mr. Harper.
I also just wanted to go back to the surplus from 2021, that $15 million.
Yes.
The breakdown of how that was used. So we reappropriated about 4.7 million of it. We used about 1.8 million to balance the budget in 2022. The rest of that 2.7 number you see there was from reserves, mainly from DSD. And then we also put $4 million into that litigation reserve per council's direction as part of that Q1 report.
Thereby proving Councilmember Philseth's adage that the surpluses get used up. Okay, great. Another quick round from my colleagues, unless people feel that we're ready to make a motion and move on. I'm seeing not much. What was taking?
I have a couple. Well, go ahead, Eric.
I just say, I think the base case is pragmatic for the moment. There's a lot of unknowns flying around. I'm sure it's going to change over the next few months, but it's a reasonable starting point.
Okay. Vice
And-
Mayor Burt?
Yeah, so as kind of part of that base, what do we now project will be the end of year BSR percentage, and how many dollars above our 18.5% target are we ballparking?
So the ACFA report that the committee just reviewed, gosh, last week, showed a surplus from FY 2021. So that is a known additional funding of a, Paul, correct me, is it 4.6?
That's correct, yes.
Awesome. Of 4.6 million. So that is above the 18.5%. What this report articulates is, in addition to that, we potentially will have an additional 10 million. The council has identified some priorities already through, general Monday night business at council meetings. So I do anticipate, in order to satisfy some of those priorities, we will be allocating some of those funds already, but definitely nowhere near in full. And so that is a component of staff's work in both, frankly, what are we investing in the near term, as well as potentially strategies in how we mitigate any of the uncertainty or investments that we may want to make over the coming near term.
So those are the dollars that got added to it from 21 and projected 22. And how do those combined dollars or what was basically the starting point? Were we at the 18.5? We're adding 4.6 million on top of FY21. That was then where were we on the BSR before that 4.6?
So the 4.6 is from FY 2021. So that is part of the 2021 BSR.
Yeah, I'm just trying to figure out at the end of this year, if we didn't have any restorations or additional expenses that we project we're going to have, how many dollars above our 18.5% do we think we'd be?
I want to say about 14 million. Is that
Okay.
correct, Paul?
That sounds about right. If that
Okay.
10 million comes
Close
in,
enough.
If the 10 million comes in, yeah.
Okay, so I'd also, just in response to one of Paul's questions, are there any potential revenue generating investments, basically? And the one that I'm aware of is the double deck driving range, which has been not moving forward in recent years, and the projections for that that whole golf course project that was on, I don't know if we called it phase 2 or whatever. And that's anticipated to be a real profit center, the best profit center, perhaps in the for the whole golf course project. And we saw as we were going through the last budget that the course itself had moved into very positive revenue. There was a question whether it would continue on that basis as we started evolving out of the pandemic. Either way, I think that's something that we should be really looking at because it showed a lot of revenue potential. And just as an aside, do we have any update, or are we holding our ground on the golf course profit, or dip back to what was the projection? If you don't know, that's okay.
Yeah, I think we would need to check with the department.
Okay. I heard anecdotally it's strong, but I don't know what that means. And then as far as the scenarios, my working assumption is that it's not A or B, it's some combination of A and B. And I was kind of taken back the way it was framed in the staff report of we were supposed to choose A or B, and there was not really an indication that neither of them are likely choice. So I think that we're going to need to make adjustments on our cost of labor to be competitive. What those will be, we remain to be seen. And I think that we really must work to restore services. And even if we can't see at what point on the horizon we get to full restoration, that needs to be part of our plan as a council, that we're going to return to the service levels that have historically been the basis in this community, and public safety and community services and everything else. So that's my working assumption, is that we're going to need to have some combination of the two. And unfortunately, unless the business tax or a stronger recovery allows us to, we won't get back to full services right away. But I think that has to be a very deliberate goal of the council representing the community. These are, I'll just add, I mean, these services that were cut a year and a half ago, it really drastically changed the services provided to our community. And as we've now seen, it had an impact on our ability to recruit and retain workforce because of a variety of conditions, both the understaffing to provide services and the compensation rates, and I think that these are things that we've got to restore to get back to being the Palo Alto that our residents and taxpayers have expected and for decades, and received a certain level of service that we can't provide right now. Thanks.
All right, then I will go ahead and move the staff recommendation.
Second.
Thank you. And let's just speak to it briefly. Much like last night, elements of A and B, we seem to be unable to choose one particular letter in the alphabet. That certainly makes sense. I think Councilmember Philseth might have used the word pragmatic for the base case. I trust our professional staff that would be the appropriate starting point. And I appreciate that they've shared, because it's important to see that if we desire to add back everything that the community used to have, which is actually worth thinking about, right? It's actually worth thinking about, were those exactly the right things? Would we want more of some things and less of others? Because things have changed and the number of people in our community during the day has changed. So I think it's worth looking at all of that. Councilmember Philseth.
Yeah, I agree with the Vice Mayor. Agree with the Vice Mayor's comments. Basically, one other thing that I would add to that, though, is that I think there are a number of things. It's more complex than just adding back the stuff we've had before. We have had some stuff that may or may not be stable in the long run. I mean, one of the things that we've had as a long-term trend that was part of our service mix, for better or worse, probably worse, right? But was there, was, I mean, we balanced our budget every year for the last 10, 15 years with a very gradual headcount decline in public safety, right? And that was an element of our meeting our budgetary targets. And I think, we need to consider that kind of stuff as we go forward in restoring services, right? We need to restore services, and we also need to look at sort of underlying sustainability issues we had before too. It's not just going back to a checkpoint. And I don't think the Vice Mayor intended that. I think just we've got to be cognizant of that. That's all.
Vice Mayor, would you care to speak to the motion?
Yeah, and I'll just follow on that. We were never fixed in time on precisely stagnant services. So by no means did I mean to imply that. But as
I hope I didn't imply that you did.
No. I'm affirming your comment. But I was referring to our general level of services, and just following on to Councilmember Philseth's comment, we over the previous years, and particularly as we came out of the Great Recession, we had a very deliberate strategic approach toward trying to deliver services more efficiently. Some of that was through greater outsourcing. Some of it was through other restructuring. And I agree very much that that needs to be part of our going forward plan in order to restore the general level of services that we've had in the community. So I think the two go hand in hand. And I know that the staff report a week ago alluded to kind of some of those needs and efforts. I very much look forward to having that presented to the council in the form of a set of concrete proposals. We haven't seen that yet, and I think that's really vital to us continuing to restore our services and do it within the constraints we have. So thanks.
All right, then we'll proceed to the vote. Vice Mayor Burt.
Yes.
I will vote yes. Councilmember Philseth.
Yep.
That passes 3-0. Thanks to you all as always. We know that there's a lot embedded underneath every single one of those lines, especially on I think it was slide 4. All right, now we turn, yes.
I was just going to say thank you to the staff on this, and also thank you to the committee on their dialogue on this. I think you have all nicely hit the right tones and the balance of where I think we're going and headed. And so that's helpful for staff to hear. And we will do our best to synthesize that when we return to the full council.
Great. Now we turn to action item 2, which is discuss updates and recommend further refinement of potential revenue generating local ballot measures.
Yes, and I will turn this over to our ballot team as soon as I address probably perhaps the elephant in the room or the surprise in the staff report when folks reviewed it. Staff did our darndest to both get initial round of polling going as well as business tax potential modeling. And unfortunately, we were unable to finish the business tax modeling component. So we have broken up what we had previously talked about publicly in the staff report of modeling for both a potential on-bill utility tax as well as a potential ballot measure. And we've divided those. So tonight before you, Jonathan Abendschein from the Utilities Department will be here to help walk us through the additional modeling and analysis associated with an on-bill tax associated with utilities. And we do expect and have identified some areas for conversation for this committee in terms of follow-up as we are actively working on the potential business tax modeling and do want to follow up and keep momentum and timing going. So just wanted to acknowledge that up front, and I will turn it over to Jonathan Abendschein.
Thank you, Director Nosey. Good evening, council members. I'm Jonathan Abendschein, Assistant Director with the Utilities Department. And as Director Nosey was saying, we're here to talk tonight about the analysis, follow-up analysis from the November 8th council direction on the utility tax. Will be coming later with the business license tax. Work on the ballot measure, I think we've talked about it in the past, is an important part of the 2021 economic recovery city council priority. And our goal for tonight is to get some refinement from the Finance Committee on the utility tax measure that's intended to replace the GFET revenue, general fund equity transfer revenue at risk due to a legal challenge. We're looking for the Finance Committee to recommend to council, and this is pending review of the polling data in January, the form of the utility tax proposal. So there's some clarifications that we're looking for that we'll talk about in a minute. And then there are some potential other provisions that we might include in a UUT, such as or sorry, not a UUT, a utility tax, such as a cap on escalation. Next slide, please. So we last met with the council on November 8th and received the direction that's shown on this slide. Just recapping from the bottom, we have moved forward on section C and D of the direction. We've launched the initial round of polling and removed the parcel tax as an option from the polling questions. Section B of the council direction is what we're discussing tonight related to the utility tax, and obviously the business license tax is analysis is still in progress. Next slide, please. This slide just goes back to the work plan. This reflects the committee and council's work over the last 6 months. Obviously, tonight we'll be talking about the utility tax. Next slide, please. In January, we're looking to talk about the business license tax. And for continuity, we're recommending that the council, we're asking that the finance committee recommend that the council convene this 2021 finance committee one more time in January 2022 to allow for discussion of that analysis. In January, we're also looking to have the council going to council with the initial polling, as well as a stakeholder engagement plan that's currently under development. And we'll be looking for direction from the council to proceed with that engagement plan. Following on that, February through April, we will continue to work with the Finance Committee and Council in refining the tax proposals, particularly based on the feedback and the outcomes that we're hearing from our engagement efforts and from a second round of polling, as well as some additional staff analysis. And the goal is obviously to have a final decision in May or June of 2022, including ballot measure language. Next slide, please. All right, tonight, drilling down a little bit on some of the feedback we're looking for on the utility tax. We have a few questions that we'd like the committee to weigh in on. First off, this may be a relatively quick item. We want to ask the committee whether to continue considering a utility users tax change to replace the general fund equity transfer revenue, or just focus on an approach that involves a percentage of revenues from the gas or electric utilities. It's not clear, I think, from prior discussions that Finance or Council actually intended to keep the UUT change on the table, but the word UUT did find its way into a prior motion, and so we want to settle that question tonight. Of the 7, we're aware of 7 measures in the last 5 years where an agency with a publicly owned utility has obtained voter approval of a utility transfer, but we're not aware of any agencies that changed their UUTs to replace, to accomplish that. They all went with a percentage of revenues approach. The next topic that we're looking for feedback on is whether to collect utility tax revenue from the gas utility only or from both the gas and electric utilities. We'll talk a little bit about the pros and cons on the next slides, but I just want to, the gas utility, collecting the revenue from the gas utility only most closely preserves the status quo, and it's the simplest to explain to voters. But we also understand the intent of the committee in looking at ways to preserve revenue if gas utilities decline over time due to electrification. We are looking for some ways to address that potential decline, even if we just collect revenue from the gas utility. Just brainstorming and sort of in the early stages of trying to come up with ideas on this front. We considered the idea of including a provision to gradually begin collecting revenue from the electric utility in the future if electrification drives down gas utility revenues. In other words, we would start collecting revenues just from the gas utility and eventually start to collect from both over time. We could investigate a provision like this if the Finance Committee asks us to. It does add complexity, and it's also, we think it's possible to simply address this issue later on, such as in a later ballot measure related to the SCAP. So that's another way of looking at it. The last topic that we're going to want to talk about here is whether to cap the total tax revenues transferred from either the gas or the gas and electric utilities. I will talk about this in a couple of slides, but the main issue here is that the current GFET methodology, the current transfer methodology, increases roughly with inflation right now. If we switch to collecting revenues based on a percentage of utility revenues, utility rates are expected to increase faster than inflation in the next few years. And so that could accelerate growth in this general fund revenue source. Obviously, that would contribute to general fund health, but it also increases the cost of using energy in Palo Alto, and it shifts the measure from one that's just focused on preserving an existing revenue source towards one that potentially raises some additional revenue. So it's just a different frame for the measure in that case. Next slide, please. So this slide, we did a little bit of analysis on the trade-offs between applying a utility tax to the gas utility only versus applying it to the gas and electric utilities. So we have gas and electric listed as method 1 and gas only as method 2. And the reason these two differ is that each utility has different operating characteristics, different shares of revenue collected from different sectors, different variability year to year based on weather or based on market prices. And so a tax that's applied only to the gas utility will have different characteristics than a tax applied to both utilities. Some of the key differences here are, first of all, ease of explanation. Method 2 is the simplest to explain because it confirms existing practice. On the other hand, the electric utility has a much more stable sales revenue. So that means that spreading tax across the gas and electric utilities will lead to less revenue volatility. The electric utility does collect a greater share of its revenue from businesses, and that means that spreading the tax across both utilities could result in more revenue being collected from businesses. And that could potentially complicate messaging if it were paired with a business license tax at the same time. I think the main goal of looking at an electric and gas utility approach was to prevent significant general fund revenue loss if the gas utility revenue declines over time because homes begin switching away from natural gas to electricity, that they start electrifying. It's possible, I think, to achieve this goal with a later measure related to the SCAP rather than trying to address this issue now. And I think it's also important, this is one thing we realized as we did the analysis, in the short term, spreading the tax across the electric and gas utilities does have the effect of increasing the cost of using electricity and decreasing the cost of using gas. And I can explain that a little bit more, dig into that a little bit more if the committee would like me to. But, in keeping a long story short, this essentially has a modest but fairly noticeable negative impact on the cost effectiveness of building electrification. And so that does increase some of the barriers to achieving our sustainability goals in the short term. So again, this is because of these different trade-offs, this is why we started looking at other potential approaches. If we were to go with method 2, is there a way over the long term to add a provision that would allow us to start collecting revenues in the longer term from the electric utility if gas revenues begin to decline significantly? Next slide, please. If we do decide to look at an electric and gas utility tax, one decision that we're going to need to make is whether to collect revenues from both, what percentage of the replacement revenue are we going to try to collect from each utility? This chart is a little bit complicated. The numbers across the top, 0%, 25%, 50, 75, and 100 represent the percentage of replacement revenue collected from the gas utility. And then below that, you're going to see the percentage of revenues tax that needs to be applied in order to collect from replacement revenue from each utility. So a 100% collection from the gas utility is all the way on the right. And that's an 18% of, we need to apply a tax of 18% of gas revenues. If you were to try and collect half of the revenue from the gas utility and half from electric, that's the third column over, you'd be looking at a 10% tax on gas revenues and a 3% on electric. And then method 1 is highlighted in gray, in method one, we're collecting 25% of the GFET replacement revenue from the gas utility, and that leads to a 5% tax on gas utility revenues and 4% on electric. I think the thing that's jumped out to me in making this chart is that it does add complexity in how to explaining the measure because of these different numbers that get applied to the different utilities. Next slide, please. So regardless of what methodology we use, whether it's just applying the tax to the gas utility or both the gas and electric, we will also need to look at the rate of general fund revenue growth under this new methodology. So revenues under the current methodology for the general fund transfer, which is based on the utility's capital asset base, it grows slowly, 1% to 2% per year. That has been in line with inflation. It's not, not so much this year, obviously, but it has been in line with inflation in the past. Switching to a percentage of revenue methodology will mean faster growth because gas and electric rates are projected to grow faster than inflation. The blue line in this chart shows the projected rate of increase of the current GFET methodology. And the green and gray bars show the growth in revenue under utility tax. The green bar is method one, which is a tax on the gas and electric utilities, and method two is a utility tax just on the gas utility alone. And you can see that the utility tax revenue from each of those two methodologies grows significantly faster than the current methodology, the blue line. This, again, contributes to general fund health, but raises the cost of energy and changes the measure from one that's just preserving an existing source to one that raises some additional revenue. If the city wanted to, we could consider including a cap on growth. We've modeled a cap that matches Bay Area inflation. Those are the yellow bars. And as you can see, with a cap, the revenues collected they're in line with the current GFET methodology. And just FYI, the inflation rates assumed in this analysis are the same as in the long-range financial forecast. So that's everything that I had to talk about. You get the next slide, please. This is our proposal for recommended motion. It has two components. First off, we would like to get a recommendation on some direction on refining the utility tax, looking at the parameters of whether to continue to pursue a UUT, whether to look at gas only or an electric and gas combined utility tax, whether or not to include a cap, and whether or not to consider any other provisions. We're also looking for a recommendation to reconvene the current finance committee in January. And I just want to note here that these recommendations, we could consider them preliminary pending council review of the polling data. These could be recommendations that the committee is making with the understanding that they could be adjusted depending on what is reflected in the polls in January. So that's everything that I have. Turn it back to the committee.
Thank you, Assistant Director Aubenschein. It's nice to see you as always. All right, we will now go to the public. Anyone who would like to address us on this topic, please raise your hand in Zoom. And let's see, I can't quite see this. Yes, 3 minutes. Thank you to the clerk. And first we will have Ken Horowitz. You have 3 minutes. Let's see, please go ahead.
Thank you. Ken Horowitz. I live at 525 Homer Avenue in Palo Alto. And I'd like the committee to consider a third option, since you're talking about potential revenue generating ballot measures, and that is a sugar sweetened beverage tax. And I know I've spoken on this a number of times recently and back in 2018. And so I think, and earlier you were talking about services that have been impacted and that have been cut over the last number of years. If we were to impose a 2 cent per ounce on a sugar sweetened beverage, I think we could generate in the city about $2 million. And $2 million will go a long way, especially if we make it clear to our residents that the money from the tax has an intended purpose to improve the health of our residents. For example, improving our parks would be a good example of using this tax. I did some research regarding other cities, and I checked out the city of Seattle. Seattle has about 10 times the size of Palo Alto. They have about 700,000 residents, and approximately 200 beverage distributors pay the tax. If we extrapolate down to Palo Alto, 1/10 the size, that would mean just 20 beverage distributors would have to pay this tax. It's a very simple process. And I think our residents, as I said earlier, could afford to pay an additional, for example, on a 16-ounce sweetened beverage tea, say a boba tea, to pay an extra 32 cents. They're already paying $5 and $6 for a tea already. And as I said, if the intended purposes is to improve the health of our residents. So I'd like the committee to consider going back to the staff and asking them to craft a ballot measure. I know it's difficult to think about a third ballot measure, but I'm not sure that a business tax or a utility tax could pass today. And I think you need to have a third option. So I'd like to recommend that you ask the staff to put together a proposal for a sugar sweetened beverage tax. Thank you so much for your time.
Thank you, Dr. Horowitz. And that concludes our speakers for this item for this evening. All right, Councilmember Philseth, you're up.
Yeah, thank you. Question for staff on this first. The options that you folks have suggested are either the UUT or else a percent of revenue. You didn't mention sort of the current calculation, which is, I guess, a little more complicated, but it's based on the asset value and potentially the margins. Why not? Why should we not consider that?
I think that our prior direction from the committee was keep it simple. And I think that the current methodology was really designed to try and mirror as much as possible an investor-owned utilities return on investment, which is a fairly complex calculation.
Okay. All right. Well, I mean, I think that you laid out the case for focusing primarily on gas pretty effectively. Right? I think, first and foremost, it's the simplest thing to explain to people, right? But also, I'm struck by a couple of things. If gas use declines, right? I mean, that's a win, right? I mean, that's what we're trying to get. And the truth is that's sort of independent of the green case, right? I mean, if that was going to happen, it was going to happen whether or not we do green, or whether green happened, right? And so it seems to me that given that our goal as a city is to try to encourage people to use less gas, right? I mean, I think we ought to take the win. And if revenue declines because of that, first of all, it was going to happen anyway. Right? Figure, as you said, figure out how we solve our revenue issue in the future, right? a couple of things, if we extend it to electrical, I think a couple of things that come into play that we probably don't want. First of all, you know, as in the Utilities Advisory Commission last week, as you guys discussed last week, electrical rates are going up pretty steeply in the next few years to begin with, right? Whether or not we do this. So if we add this on top, I think, you know, it's going to be hard to explain to people why rates are going up, and we also want to make them go up even faster on electricity. It's not consistent with sort of our focus of encouraging people to switch from gas to electricity. And I think that, you know, the climate argument is one that I think will resonate with voters on the gas thing. Again, we're going to, essentially what we're talking about is taxing fossil gas, but not clean electricity, which is, I think, the way that we want people to think about it. And I think many people will think about it that way. And then finally, and you know, as long as I think we're clear, and you know, and Dr. Horowitz touched on this briefly too, as long as we're clear that the benefit of this is to help restore some of the services we lost in the pandemic, I think, you know, those things put together make the most compelling case, I think, for voters to do this, right? And I think we murky our message and our value proposition together if we extend it over to the gas side or to the electricity side. So I'd be in favor of continuing to focus on gas. And then staff is arguing whether we do a profit basis or a percent of revenue or a UUT-based basis. And I think your argument for the percent of revenue basis is weightier than the UUT thing. Thanks.
I think that's the first time I've heard murky used as a verb. Vice Mayor Burt.
Yeah, so I agree with what Councilmember Philseth was just saying, and appreciate that staff coming forward kind of under the presumed principle that the more complex a ballot measure, the less support it's likely to have, and conversely, the simpler it is, the better chance it'll have support. But we're in kind of a blind spot because we're looking at making recommendations without being informed by the polling. But remind me, we don't have the final polling in front of us, although we did have a draft outline. Were there questions? What questions were there on this subject or around this subject versus the business tax?
I believe we touched on both business license tax and the utility tax, and polled on whether or not it should be a UUT or a percent of revenue.
Okay, good. Well, that will be informative. And when do we think that staff will receive the initial polling results?
FM3 is wrapping up their work and analysis, and staff should start reviewing it or see results of that next week. And so we want to look at that internally and then release that to the council in January 2022.
Okay, I appreciate that you want to do that internally. I'm not sure how much lag there should be between when you've done your review and it's released to the council. You know, we would be agendizing it. There's also a question of on the timeline, we had an upcoming finance committee meeting that was going to be looking at further refinement on the business tax, but the polling would go to the council. I'm trying to recall, was our assumption previously, though, that it was going to come to the finance committee because it would just be ripe by the time of this meeting, or hope was, I should say. And so that means that it won't be flushed out by a finance committee, whoever's on that. Either way, I think it might be helpful to digest that and more than just in a normal timeframe before a council meeting or a finance committee meeting. I'm not sure. Really, we might want to wait in if the council agenda doesn't allow airing of this before the first finance committee meeting, then I'd kind of be inclined to have the finance committee review the polling before the council. But if the best way to move the ball forward, because we're going to be a little bit behind our timeline, is to go straight to the council, I'm good with that too. So I think that that I also agree that the percent of revenue is the simplest approach. It links to the revenue loss that we had, and it does tack it on to the natural gas rather than electricity. So from a incentive standpoint, and perhaps even from a voter support standpoint for climate related issues, all those things seem to be adding up to that would be the preferred approach if the polling supports that. You know, we hear from sometimes members of the community or even the press that the polling somehow a finger to the wind, but polling is getting a sense of the democratic support of the electorate for taxes and how they want to be taxed and at what scale and what form. So I just want to make sure that, you know, that we really reaffirm that polling is a really appropriate thing, because it informs us on what the electorate thinks is reasonable. So with stating that preference for the percent of revenue, if it was going to be if that for some reason didn't pan out in the polling and we had to look at provisions and forms of the UUT, that gets stickier, and I'm hoping the polling would even inform that well, because I think we can come to a pretty strong preference in what we'd like, but if it was refuted by the polling, then we've got various questions. And my concern is that an 18% utility users tax on gas leaps off the page as a big percent number. It's the same dollar figure, however we spread it, but I'm going to be surprised if the electorate likes the sound of that. And so that would be a reason that I'd be guided by the polling to perhaps be willing to go a combination of gas and electric. Hopefully that's not what the polling will support. And let's see. Oh, I just did have one question on slide 7, which I think is page 5 of the staff report, maybe. Jonathan, you were breaking down the impacts of the different utilities taxes on gas and electric, or a combo. What percentage of our current gas revenue is from commercial, and what percentage of our current electricity revenue is from commercial or non-residential?
Yeah, so about 60% of gas revenue is from non-residential, and a little bit over 80% of electric revenue is from non-residential.
Okay.
So, and because so much of the revenue in method 1 comes from the electric utility, that really dominates it really pulls the amount that's collected from businesses towards that electric percentage.
And one of the things that I'm not sure we have reflected in the poll, but you had in the staff report again, which is showing what well, you had it on the gas. Actually, in the staff report, we didn't have a comparison of our electric rates versus PG&E. I think we just have the gas, and I think as it goes to the council, that would be helpful. And I think I don't know that's part of the polling, but I think it could influence future polling because we have this false refrain that's been out in the community that somehow we're paying exorbitant electric rates when we're 40% below PG&E. And even though our rates are due to go up, including because of PG&E's increased transmission costs, their rates are really scheduled to escalate. I think more than we're projecting on our rate increases in the coming years, certainly not less. And so that I think would have a big impact on people's thinking. And then it's a question for, and this again, maybe for the second round of polling, but because of the that would only, this statement would only apply if the first polling indicated a UUT was the right approach, and a method one would be, and that is that those rate increases, well, no, I take it back. It would apply even for the transfer, for the public to understand that the biggest proportion of those dollars are coming from businesses, and they're not coming from the residents. And with the exception of people who are identifying both working here and residing here, it may have more receptivity if they understand that they're basically having their services supported disproportionately in this case by businesses and that increase. So I don't know the most succinct way to put that in a poll, but I think that that would be interesting to find out how that affects the receptivity for what will hopefully be the percent revenue transfer, which would be the 60% from business. So thanks.
Eric, did you have a follow-up, or are you just getting ready for round two?
Somewhere in between.
Shall I let you go first, or shall I take my turn? That's my question.
You go ahead and take your, you go ahead and I'll go after you.
All right. Okay. I want to start by thanking staff for the really thorough analysis. It was a little bit like going through the ballot measures. You're like, this sounds like a great idea. Oh, wait, maybe it doesn't. Oh, now I have to think about this other thing. So including the information about the cap, which my colleagues have not yet addressed, but I think is worthy of consideration. I agree that we could make this as I think like what we do with the budget, a tentative recommendation, pending input from the polling. I'm certainly willing to consider staff's recommendation that this particular finance committee reconvene in January, especially if that solves the timing issue with getting things on council meeting agendas and when things are available. If that's helpful, I'm happy to do it. If it would be appropriate for the next finance committee to be in charge, then I'd understand that as well. So aligned with Councilmember Phil Seth on method 2, for all the reasons he stated, I think the laying them out on page 5 of the report, packet page 59 was quite helpful. And then, when you go to the detail in attachment A3 and you walk through, why this is simpler, why it's easier to understand, that's incredibly important. I know we had talked earlier about, oh, well, if we put it on gas and electric, then we don't have to worry about when the revenues shift over time, based not only based, on climate goals and people taking action on that. But I'm confident that our staff will be able to see those transitions and manage them as we go. Because these are enormous changes, as Mr. Aubenschein of the utility group knows, it's not going to happen overnight. We're gonna have a lot of forewarning of when people are going to need to make these changes. So I will. That's where I am on that. Would you mind just putting up the slide with the decisions you need from us tonight? I feel that I might have lost one. They're looking for it. Okay, so we've talked about little whatever, A1, A2. We haven't discussed A3. So interested to hear what my colleagues have to say on this next and hopefully final go round. Councilmember Philseth.
Yeah, thank you. I want to sort of pick up where actually both Chair Cormack and Vice Mayor Burt were left off here a second on the, the 18% as a number without context is, kind of an eyebrow raising kind of number, right? Without context. I wonder if when we ask this in polling, and in fact, if we should get as far as going to the voters, we shouldn't try to contextualize that a little bit. And rather than just saying, do you want an 18% increase in your gas bill? Right? Discuss it as, we're going to add a surcharge equal to the GFET, right? Which was removed, right? And restore that, a surcharge to restore the revenue from the GFET, or some words to that effect, and to contextualize it a little bit as opposed to just I think. And to the Vice Mayor's point, I think, we all know our electrical rates are substantially lower than PG&E's. I thought our gas rates are a little lower than PG&E's as well, right? And if there were some of that, if when we restore, we're going to restore the GFET, right? And we'll still be, 10% or 5% or whatever it is less than PG&E's gas rates when we're done. So I think, that would be that would be a pretty important context to understand the other stuff, as opposed to we just show up and say, would you like an 18% increase in your gas bill, right? I think so. I think setting the context for that's kind of important. The other thing that Councilmember Cormack brought up, thank you very much. The index to inflation, the cap. I guess I'd be interested to see what the poll says about that. But my instinct, but this is focus group of one, right, is that that people would sort of help. That would help people sort of understand that what we're doing is restoring. We're restoring the cap, and it's we're restoring the GFET, right? And it's going to be tied to inflation, so it's not going to increase exponentially and stuff like that. My sense is that that's a sensible thing, although it complexifies this a little bit. But again, I think they'd be interested in seeing polling on that as opposed to sort of brainstorming. Thanks.
Ms. Dunn?
So just to clarify, Councilmember Philseth, my understanding is that the GFET has not been removed from the rate base. So this would not be, it should not be an increase in general in ratepayers' bills. Rather, it's a confirmation. So the city has continued to collect it, but has reserved it.
Right, and if that could be the language as opposed to, an 18% surcharge on your 18% change to gas revenue or to your gas rate, right?
So we will, in the materials, we will need to disclose to voters that it amounts to an average of 18% of a typical user's bill, or some language to that effect. But I think that the lead on it really is, do the voters want to confirm the current status quo of the way that the gas rates are formulated to include this transfer for general fund purposes, such as police officers, 911 services, librarians, et cetera.
And we would simplify the algorithm to be just a percentage of revenue, as opposed to a calculation involving math. I mean, there's a simpler way to say that than I'm saying it right now, but
absolutely.
We'd also simplify the way we calculate it, right?
Yes, and that will be explained in as clear and simple language as possible to voters. Remember that complicated GFET formula is not something that people ever see.
Right.
So we don't need to dwell on that. That was something that was done in the rate setting process each time the city changed rates. So we would be presenting a simplified version which is substantially equivalent to the current status quo.
Let me ask a devil's advocate question. If we thought, I mean, this is we're getting into the realm of psychology here, right? But which I hate, because once you get humans in the data path, everything goes to hell. But if you ask people the way you said it, can we continue to collect the equity transfer versus can we collect an 18% surcharge on top of your bill? And if we thought people were going to opt for the first one, but not the second, is it worth continuing the first one? Even though it's more complicated.
Before staff answers, can I just throw out, it might be helpful for you to be looking at attachment A. If you look at the language that the city of Burbank used, continue the past practice, okay?
Yeah.
Or look at the language of city of Sacramento, which
Right.
will not result in any changes to existing city utility rates. Like, people have figured out how to describe this in a straightforward, manner.
Fair enough. Fair
Yeah,
enough.
so I just want to be, let's not try to make it up. We've got some options there to work.
Yeah, but
Fair enough.
can I jump in here, because I think there's been a misunderstanding. When I was talking about the 18%, that was on the UUT, isn't it? That we would be increasing that UUT on gas by 18%. John, is that correct?
No, essentially the current GFET is about 18% of revenues. So we would say, please confirm our existing practice of transferring.
That's right.
about
So we could say it
18%.
that way, but if we put it on UUT, it would have to be more explicitly a percent increase on the gas UUT.
Yes, and what's interesting about this, and I don't know, I think I need to double check this, but I believe, so if I'm doing the math right in my head, I believe the percentage ends up being a lot higher if it's a UUT on gas revenues rather than a percentage of revenues.
That was my recollection.
24%, I think
The
it
number
was.
was like astronomical.
Because it's on the base, right?
Right. The
It's-
base
But I
is
also like
correct.
the way that that Jonathan just said it too, which is, can we continue our practice of transferring 18 cents of every dollar into the general fund to fund?
We will work on ballot language, and we certainly will do, as Councilmember Cormack suggests, which is to look at the examples that have gone before us. Obviously, cities have done it in slightly different ways, but some of them are quite elegant and straightforward. We do have a legal obligation to close at a certain level. But I think the committee will, or the future finance committee will benefit from beginning to look at some of this language, and that's definitely some work that we'll do early in the new year.
Okay, I'll shut up and stop flogging this.
All right, Vice Mayor Burt, anything to add?
Yeah, just that reiterating what I was just trying to get at before. So I think the percent of revenues will find that the ballot language is easier to convey in a way that doesn't make the voter think that they're paying some new tax. The UUT was my concern, that I think that becomes will have the appearance of a significant new tax on gas, whatever that percentage is. And that was the point I was making. So that's in support of the argument that the equity transfer will hopefully be well received, because I do think it will have a better messaging. And then as far as on the cap, I mean, in reality, we have a cap both ways. We have a cap on percent of revenue, and the other is a cap on that based upon CPI. So there are two caps. I just want to make sure as we go forward on messaging, we'll have plenty of time to do this, that we don't frame one as a cap and the other not a cap. They're two different caps, and certainly one we expect to be lower than the other. But I just wanted to toss out that nuance. And I did want to acknowledge Mr. Horowitz and the points he's been making on the merits of a a beverage tax, a sweetened beverage tax. But I think as all of us are aware that first we're going to find out from the polling whether we can have two measures on the same ballot if we have a business tax and this. Hopefully that the equity transfer will not be perceived as a new tax, and we might be able to have both of them. But having three would be tough, and the beverage tax is a lot fewer dollars than either of these others, and a lot less consequence to trying to address the real severe needs of the city. I think that we're looking like we're on the right track and chomping at the bit to see the polling. Thanks.
I'll just add to Dr. Horowitz, whom I've spoken with about this a few times, that I think one of the options that staff might want to consider in council is, in the same way we have a capital infrastructure plan that goes out 5 years and a long range financial forecast that goes out 10 years. We might want to start mapping some of these other potential taxes we've talked about into different timeframes, whether it's a surcharge on the documentary transfer tax, or a sweetened beverage tax, or perhaps something that's a climate action bond or parcel. I think it just helps to have them written down somewhere, and so we can think about matching sources and uses of funds. I realize we haven't done it that way in the past, but I just throw that out as one way that it might be helpful for finance committee staff, council, and the public to see what our options are and look forward. So just throw that out. Okay, well, I think we are, I don't have.
I'm sorry, can I just briefly respond to that last thing? I appreciate the value of thinking longer term on these things in terms of having support by the electorate for an upcoming tax. Implying to them that there's a lineup of additional taxes following that on the horizon could undermine our efforts. And so I think there's a trade-off there, and we need to be conscious of that.
Well, and I that's fine. There may be a trade-off. I am conscious of it, but in general, my preference is for transparency and matching sources and uses of funds. And I think it's, in a finance committee that switches every year, I think having some consistency, especially when we have so many unfunded needs, frankly. Slide 7, there are a lot of unfunded needs there. And we really haven't answered to the community. How are we going to pay for, the train crossings, for example? Okay, at this point, I'm ready to entertain motions. And if the staff would be so kind as to put back up the slide, let's make sure we capture everything that you need from us this evening.
So I'll try to move something here if it's okay.
Go ahead.
I'll move that we direct staff to pursue preparation of utility tax to replace the GFET with the following parameters: percent of revenues focused on gas only, capped or uncapped to be determined or to be explored through polling.
And what about B?
And yes, and B as well.
Okay, I'll second that, especially if you put the word tentative in A.
Okay, I'm good with that.
And then in B, I guess we should just have something, subject to staff recommendation, because lots could change between now and next month.
Yep.
All right, would you care to speak to your motion? Let me just wait a moment while the clerk catches up. So it was, yes, go ahead.
Excuse me, Madam Chair. Just on B, so really it's the prerogative under the municipal code of the mayor to constitute committees. And so just in thinking about this, I think what's requested here is that there be an early meeting, and that for continuity's sake, it be constituted of this current calendar year's finance committee, and then pending the next mayor in the ordinary course later in January, selecting and appointing an ongoing finance committee, which may differ in membership from this group. So I think it's not really a fully a
Okay.
staff matter. I think it would be the new mayor who the council will choose on the 3rd, who would then indicate that this can occur in this way.
So B, should read request the new mayor to reconvene the current finance committee.
Yes.
Okay, request that the next mayor
Yes.
reconvene the current finance committee. I still feel like subject to staff recommendation makes sense because it sounds like there were some timing issues. I see
I think that's
Director
appropriate.
Nosey nodding. Okay.
I think what staff is looking for is ultimately, as our attorney Molly has identified, is that we're just trying not to lose time. And so as the council is considering their reorganization in the January timeframe, and for the sake of continuity, since we've invested a lot of time with this committee and getting them all up to speed on this kind of next step, just trying to see that through during the month of January, if all stars align. And so I think if that flexibility is amenable to the committee, that would be preferable.
I'm going to interpret B as each of the 3 of us is willing to do another meeting.
Well,
And
I have
everyone
a-
else can decide if we should.
maybe this is too mannered, but I mean, should we just be not specific about it? Because the issue is is the issue just whether the mayor has produced a new finance committee. So if we have a new mayor on January 3rd and he or she produces a new finance committee on January 4th, then if the meeting is on January 20th, should it be the current finance committee or the next one?
So I'll just add that I think it's typical that after January 3rd, there'd be a solicitation of council members for committees and other bodies that they are interested in being participants in.
Yeah.
And so that just even getting that information takes a while. So even if it was done expeditiously, it wouldn't happen right away.
Right.
And maybe we have this additional interest of keeping this ball rolling. And if we're going to have, in particular, we're only talking here under B about the additional modeling, and we haven't talked about the polling review.
I totally agree.
Yeah, and I would be even more inclined to have a special meeting of a carryover finance committee to review the polling, and then give guidance to the council on that as well. And so, maybe that we could have a tentative scheduling of that carryover finance committee for even the first week of January, and then it doesn't get into this whole ambiguity of whether it should be the new finance committee or not, because we wouldn't have one appointed yet.
Well, I totally agree. I'm going on the principle that the finance committee is a finance committee until there's a new finance committee, and if there isn't a new one, then the old one is still a finance committee, and we're not excused from our job, right? That's all. But again, it may be too mannered. Right?
Eric's famous plan of record. Would staff like us to include polling in section B?
I think that's the discretion of the committee. I think what we're hearing from the committee is the willingness, frankly, to continue the work as necessary as things are ready. And I think that's the direction and confirmation from the committee that we need to take to the new mayor. I think this committee has identified, frankly, all of the variables at play, and I appreciate that flexibility.
Yeah, but this is going to the council. So if there is an inclination to have the finance committee review the polling, I think we ought to put it in there.
So the council has identified already, actually, that the finance committee, if time allows, can take the first stab at reviewing polling. So I actually don't think you need council direction on that. The committee put that forward as part of the November planning with the council. And so
yeah, but
I think
this has
that
changed
piece is
things.
good.
That was under the assumption that that we would be doing that basically at this meeting. So I think it's just for clarity to the council on the intention, would be good to add, and potentially polling to be.
And I guess my only concern is that this won't go to the council potentially before the first or second week, as you just identified it in January.
Well, good
And so
point. Okay.
just want to acknowledge that a lot of this is identifying the willingness of this committee, as well as then ultimately coordination with the new mayor in the new year, just as Attorney Stump has identified that it's ultimately at their discretion. And this is kind of the collective staff and the
Well, then it kind of makes B moot. If the new if the old finance committee was going to meet in January before the council would consider the motion, it kind of makes B moot.
I heard Director No say that mainly they wanted to know if the three of us were willing to meet in January.
Yeah, and the reason is, Councilmember Burt, Vice Mayor Burt, is to take up this other topic, which is not addressed tonight.
Yeah, but we don't need a motion to ask each other if we're willing to meet. So if this is going to the council, why don't we go ahead and put in prospective polling, because then it will at least be a heads up to them that that's an intention. Otherwise, it is kind of moot. If you've got a question whether we're willing to meet, we often just say, yeah, we're willing to meet. But this is a motion to the council that will be potentially out of sequence. But I'm okay putting it in there just to convey that the finance committee's recommendation, even if they may not be able to consider it before the finance committee meets in January.
Right.
Okay, let me
it allows
suggest an
some
amendment.
transparency. Yeah.
Let me suggest a change to B. Direct staff to consider reconvening the current finance committee with the agreement of the next mayor. And then you can delete up until in January 22. So, sorry, after committee, I'm in the first, consider reconvening the current finance committee, not final committee. Tempting though. I thought this was our final meeting. Comma after
Like
committee.
final destination, right?
Comma after committee. Comma after the next mayor. Thank you. In January 22 to review additional modeling and refinements of a potential business license tax, comma, polling information that is available. Yes, staff, any polling information that is available. And then shall we get rid of subject to staff recommendation, because we're now directing staff to consider it. Yeah. Okay, I see staff nodding. Councilmember Philseth is the maker of the motion.
It's acceptable to me. You probably need an and after license tax, but yeah.
Well, and delete it after modeling, I think.
Fine.
Oh, no, I'm sorry. No, that's fine after modeling.
Okay, and I recognize that Councilmember Philseth still hasn't spoken to his motion. So
I think
Vice
I've
Mayor
already
Burt,
spoke.
any changes
Thank
to
you.
be?
I think I've already spoken to it.
Yeah, okay. All right, so I'll speak to it. Boy, we've come a long way. Made a lot of progress on this. And again, I just want to appreciate the really thorough analysis of the staff report tonight. Topics in there that we had, certainly the members of the committee had not contemplated. And I appreciate all the thought that went into it. And with respect to B, if there's work that needs to be done, happy to do that in January. All right, Vice Mayor, would you care to speak to the motion?
I'm good.
All right, we'll go ahead and vote, beginning with Vice Mayor Burt.
Yes.
I will vote yes, and Councilmember Philseth.
No, I mean, yes.
All right, that passes 3-0. And thank you again. And now we move to our first quarter financial report. This is an informational item. And are we having a presentation, or is this the kind of informational item where it just shows up and we don't discuss it?
The latter.
Oh, excellent. Okay, because it is listed as an action item on our agenda.
Yes, and that's simply because on actually committee agendas, we don't have information as a topic. And ultimately, if I'm being, fully transparent, typically we would discuss something like this and we would have a presentation as staff. However, in this ever-changing world, we've been taking an added step of doing the preliminary quarterly reports. And so I have frankly asked staff to continue maintaining issuance of the routine quarterly reports, the final numbers, so that we have that financial record as we move through this period of time. So that's why at this point, staff doesn't really have any items for discussion, since the council has actually been briefed on all of this information a few months ago.
Okay, so should
So-
we take it up or not?
I think if you generally, as a committee, ask any questions, allow the public to speak if any have any public comment, and then just accept the report, that's sufficient.
Okay, great. All right. So there's no staff report. All righty then. Would any members of the public care to address us on the first quarter financial report for fiscal year 2022? I don't see any, and the clerk could please confirm.
That is confirmed, Chair.
Thank you so much. And do either of my colleagues have any questions or comments on this report?
Nope.
I'm not seeing any hands. I'll just say that, we talked about TOT, average daily room rate at 156, but occupancy up to 60, so that was good. And then I think it'll just be worth discussing the next time it comes. It looks like fire overtime in Q1 alone was pretty significant. And so I think that's worth discussion the next time we have this in more detail. All right, so would you like us to formally accept it, or is that not necessary?
I actually don't know the formality of it. It is
Move
identified
to
as an
accept.
info. Thank you.
Second.
Okay, great.
All right.
Thank you.
Any discussion on that? All right, we'll go ahead and vote. Vice Mayor Burt.
Yes.
I vote yes. Councilmember
Yes.
Filseth votes yes,
Yes.
so that is accepted also on a 3-0 vote. And that brings us to future meetings, and agendas, which we may or may not have in January. We've probably already discussed that thoroughly. Does staff have anything else before we adjourn?
We do not. Just want to say thank you to this committee. We've relied heavily on this committee over the past 12 months to really work through some tough issues, and just appreciate your engagement on these and kind of working through them with us so that we could go to the full council with a more fully fleshed product. So thank you all for your work this past year.
Very nice working with you guys this year.
Yeah,
Yeah.
thank you.
Lots of thanks to staff. This is the first year that the Finance Committee has conducted all of its business on Zoom, first calendar year.
Yes.
And really, it's been a pleasure, even when we had disagreements, and we certainly had many of them. I'm pleased with how well everyone handled them, and the depth of analysis that you always bring. So with that, we're adjourned, and maybe it was our last meeting, and if it was, thanks, and if not, we'll see you in January.
Absolutely.
Thank you.
Thanks all. Good
Bye.
night.
Thanks, everyone.